Retiring with a pension and 401k, that brings some extra complexity to be thinking about whenever you are planning for retirement. A pension is an amazing vehicle because it gives you a guaranteed income stream for the rest of your life and potentially your spouse's life if you're married. And so that's a wonderful benefit that many companies used to offer. Not so many companies offer it anymore. I know Disney, for example, Disney does have a pension. So the Disney pension it still exists for those that started working before 2012. There are other companies that have pensions as well. Federal government has pensions, and the pension availability sometimes has been based on uh, when you started working with the company. So, for instance, Disney's pension, the traditional pension is really based on those that started working that were salaried workers before 2012. Post 2012, Disney changed their pension to a cash balance plan, which is a different video for a different topic for a different day. Now, when it comes to having a pension with your 401k as well, hopefully you were able to save into a 401k or IRA or what have you post or during, on top of whatever the pension benefit is. And so whenever you're retiring with a pension and with a 401k combined, there brings some extra complexity to think through. So here's how I think about these different aspects of it. So the first thing is timing. Whenever it comes to using your pension and using your 401k, the timing of when you take that income matters greatly, especially when it comes to the pension, because the pension, typically there's some modeling and how they're investing the money on your behalf and all of that stuff bakes into the amount of monthly income that you're going to receive. So the earlier you draw, the less benefit you typically will have. However, you don't want to wait too long because, for instance, the Disney pension, the maximum claiming age is at 65. Unless, of course, you work past 65, then they'll keep adding to that benefit. But if you're retiring around 65 or before 65, the maximum claiming age or the maximum benefit is at age 65. So whenever it comes to claiming at age 65, you want to think about, if you want to claim earlier, the ramifications of that, not only initially, maybe it's just a few $100s a month difference, or maybe $1,000 a month difference between maybe claiming at 64 and 65, for example. However, the big risk is with the longevity of a pension. The Disney pension, for example, does not adjust for inflation. So inflation then comes into factor. And so if you claim early, you have a reduced benefit, but that benefit never increases over time. So the timing of taking it matters immensely. The other aspect of timing is when it comes to the 401k. So the 401k, if it's a traditional 401k, you'll have to start taking withdrawals out at your required minimum distribution age, which Congress just passed with the Secure Act 2.0. For most people now, it's 73. There's a transition period where it's at 72, but for many people now, it's age 73 to 75, depending on what your year of birth is. So we know that you're going to have to take money out of your traditional 401k at that time. However, depending on when you start your pension, maybe you want to use your 401k before that, or maybe use it after that, or maybe you want to realize taxes somewhat to minimize your overall tax burden for your entire situation. So the timing is pivotal. The second thing that I think about is inflation. How does inflation impact your pension? For instance, the Disney pension does not adjust for inflation. So while it may be a nice payment initially, 20 years down the road when you're maybe hitting into your 80s, late 70s, early 80s, that benefit loses much of its value or loses a lot of the value because inflation continues ticking along and the benefit stays the same. So you want to be planning for that whenever you're looking at your retirement plans, your retirement income, and that's where being careful with how you use the 401k can help maybe offset some of those additional costs that come in as inflation really starts to seep in and you start to really feel it after that 15, 20-year mark of retirement. Now, not all pensions are created uniquely. So some will adjust for inflation, some won't. Some will have certain measures that they're adjusting for inflation. Some will follow just whatever the government's is. Sometimes they'll just put a set inflation benefit in there. Sometimes they're called cost of living adjustments as well. So understanding how inflation impacts your pension is a big part of the overall planning when it comes to a pension. And then that will then help guide you on how you should use your 401k to generate income or to save and invest for even down the road in retirement. The third thing that I think about is the survivor benefit. Whenever one is claiming a pension, for instance, the Disney pension does have several options for benefits for your survivor. One is 100% joint to your survivor. So let's say your benefit is $2,000 a month, and you pass away, your spouse would receive $2,000 a month because it's 100% of the benefit. But there's also a 75% and a 50%. So the 50%, for example, would be if you had $2,000 a month, your survivor would only receive $1,000 a month. So you want to understand whenever you're making your election, how much of that benefit is going to go to your survivor, and how does that impact future plans, especially if you were to pass away early. Another option on the Disney pension plan is a certain life period, which basically means it's a 10-year period, certain life, which in essence means payments are guaranteed for 10 years. But if you pass away in that 10-year period, they'll continue on. So let's say you pass away at year 7 and there's 3 years left of that 10-year period, your beneficiary, whomever that might be, your spouse or whomever, will get 3 more years of payments. But let's say you have the 10-year life certain period annuity pension payment, you're going to have 10 years of payments, and let's say you pass away at year 12, well, then nobody that survives you gets anything at that time. So there are a lot of different options when it comes to Disney pension. A lot of other pensions have the similar setup. I know like the Florida Retirement System pension, there are 4 different options that you can choose depending on, if 100% to your survivor, 75%, 50%, or a period certain option as well. So there's a lot of different options when it comes to pensions, and thinking through how is this going to impact me not only now when I want to retire or getting closer to retirement, but also how's it going to impact my spouse upon my passing, and how do we think through that? The fourth thing that I think about when it comes to a pension and Social Security is the taxes. So pensions, for the most part, are taxed as ordinary income. So whenever you start claiming that pension, it's going to be taxed at whatever your ordinary income rates are. So a lot of people where taxes in retirement is confusing. I've done some videos and articles on taxes in retirement. But if you look at, so let's say your pension is $2,000 a month, and so it's $24,000 for the year. And let's say you didn't have any other income, your taxable income for that year would be $24,000. Then, of course, you would reduce it by your standard deduction, whether that's married, single, or married, filing joint. Or if you have other deductions that are greater than your standard deduction, certainly that would offset that income. However, most of the time, pension is not the only income. You might have pension. You also then have your 401k withdrawals. So your 401k withdrawals, if it's a traditional account, are going to be taxable as well. So you add those two together, and so maybe it's 24,000 from here and 24,000 from here. So then your total income is 48,000, and that's going to be all taxable income. Now, so you want to be cognizant of the tax ramifications of your pension with your 401k, because sometimes folks will be thinking, oh, hey, my pension's going to be $2,000 a month. Awesome. They forget that Uncle Sam wants his cut. So yeah, that $2,000 after taxes might end up being $1,800 or $1,700 or $1,600 a month versus $2,000 based on whatever your tax rates are, or your tax situation. So you got to be cognizant of taxes whenever it comes to your pension and 401k. Finally, one more thing that I think about, of course, there's lots that can be added to this list, but one more thing that I think about whenever we're considering retiring with a pension and 401k is the impact on insurance, both health insurance before Medicare and Medicare premiums as well. So this is something that is still new enough that a lot of folks don't really consider, but whenever you're retiring before 65, but you're no longer on your employer plan, you certainly can do what's called the COBRA insurance, which is basically just continuing on your employer's health insurance plan. However, there are other options as well. One of those is using like the Affordable Care Act exchanges or some, the often called Obamacare exchanges for insurance. And if you use those exchanges, then you, depending on what your income is, you may be able to qualify for some tax credits against that premium. So a premium may be $1,000, but you get tax credits that brings it down to $200 a month. So understanding how your pension and your 401k withdrawals combine add to your income and maybe potentially impact your ability to get tax credits before 65 is pivotal. Then at 65, once you're on Medicare, Medicare does have what's called IRMA, income respective to modified adjusted gross income, where basically the income that you make, if you make too much income or you have too much taxable income, it's going to then make your Medicare premiums increase, sometimes substantially so. And so we want to consider the timing of those 401k withdrawals with your pension income and how do those work together to impact your potential insurance premiums, whether that's before Medicare or after Medicare. That was a lot, I know. And whenever it comes to retirement planning, it is a whole new ball game. And retiring with a pension and 401k, typically, hey, it's great that you have these benefits, but you want to understand how they work, all the different ramifications of them, both short term and long term, to be able to feel good about your decisions. Try to save as much money as you can on taxes and make sure that money lasts as long as you need it to.